Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. Now to drive the China story forward in economics, finance, and investment. Joining us right now, Virginie Maissonueve, Global CIO of Equity at Allianz as well. Virginie, I'm sure you've done this, but if you're at the restaurant Café Monsieur Dior at 30 Montagne in Paris, and you sat down with Mr. Arnault or his offspring and said, what about China? How would you brief the Arnault family now on the vibrancy and the future of China consumption?
Well, thank you. That's a great. I love the staging here. It's quite fun. Listen, I think China clearly has gone through a tough time, and when you see particularly demand in luxury good and the substitution that we start seeing within China, luxury is finding it quite tough. However, there is a lot of negative sentiment on China, and I think the packages that they've put yesterday are still underestimated by a lot of investors, particularly because of the impact it could have on domestic consumption confidence as it relates to the property market.
Do you just assume fiscal stimulus to come? We're all going Keynes today. When the facts change, Beijing changes?
Yeah, I think fiscal stimulus is needed. The current package is quite big, as you know, in terms of support to property and capital markets. But what I would like to see is an AMC for property, basically an asset management company, the same way we had, you remember, in some of the previous crises to help with the bank's NPLs. I'm not saying this is going to be announced, but what I'm saying is it would make a lot of sense as a next step. And you can see how China has timed the release of this package after the Fed cut so that the impact on the currency versus the dollar was not too strong. And so I think we'll have more coming.
We say good morning to the Arnault family and everyone else listening in the 8th this morning in Paris. Virginie, let me ask you just about the market reaction to all of this. And baked into these plans announced by the PBOC in China was this stock stabilization fund. Our friend John Authers, our colleague John Authers, referring to that as kind of like a Fed put, in effect. You look at how this is rippling out through Asia, not really rippling out throughout Europe and the U.S. as one might think. How do you see the market effects, the knock-on effects of what's happened in China over these last couple of days?
Yeah, so I think it's not only China. I think it's we're at an interesting point in the markets with key things in the macroeconomy, the political economy, and the financial economy. So on one hand, you have had all those announcements, and of course, positive sentiment on China has an impact on Asia. But you also have the impact of the Fed rate cuts, which of course is going to have an impact on areas that are strongly anchored around property, and you can see that with Hong Kong, for example. So I think it's a convergence of those two trends that is supporting markets.
Love to pull back and look at the United States as well, and you've written about this tension that exists between the political cycle and the economic cycle here in the United States. Where do you see most of that tension lying? Is it in terms of tax policy, tariffs policy, if we want to keep with the China theme that we're having this morning? I think a lot of people downplay the sort of role that an election might have just exclusively. But when you look at policy going forward under either of these two administrations, what stands out to you the most? What's likely to have the biggest effect?
Yeah, so I think on one hand you have continuity, on the other hand you have unknown, with a lot of potential announcements that, if you actually look at the announcement and the impact on finances of the country, or the realistic, the pragmatic view of how you implement those, a little bit more questionable, I would say. So we would look at inflation through tariffs if we have one administration versus another. Debt sustainability has been a big topic of mine for over 12 months now. As you know, if you have continuation of the corporate tax rate cut, that's about $5-6 trillion. Right. But if you have more happening, how do we financing at the time where we're quite leveraged, and of course the cost of financing that debt is coming down, but the long end is not coming down as much, right?
Virginie, what is the cost of having too much cash in a portfolio right now into 2025? Have the facts changed, so I've got to look differently at cash, triple leveraged or not?
Yeah, so as you know, most of our clients in equities have maximum cash, generally 5%. So, but you can absolutely be at there. You're still getting some interesting returns on your cash, but I think the way to navigate that volatility is really more about a balancing. So in the developed market, having that balanced portfolios between the cyclical aspect of the stocks who might do well on those rate cuts and a more defensive, element of the portfolio, continuing, however, to have your tech long-term stocks, right? At the same time, what you're seeing is exposure, more opportunistic exposure, perhaps in emerging markets or China. In Asia, we still like Japan. And we like China as really an area of the market that's very anti-consensus.
Virginie, thank you so much. See you at Montagne 30 there in the Dior Cafe. Virginie Maissonueve of Paris, and of course always of Allianz as well. One of the great moments of late September into early October, and I will go back as far as a gentleman from Iowa who supported FDR and then became a conservative Republican and moved to the center to get elected. His name was Ronald Reagan, and maybe that's a moment we are with these two candidates as they frame out who to move to the center. The governor from Connecticut is more than skilled at this discussion. We should point out that Governor Lamont's wife, Annie Lamont, serves as a board member of Bloomberg LP, the parent company of Bloomberg Radio. Ned Lamont, David Gura, knows a lot about moving to the center.
Governor Lamont, great to have you with us. And let me start here just by asking you about the speech that we're going to hear today from the vice president in Pittsburgh, a major economic address. I was reading extracurricularly this morning, looked at the Times, and Jim Tankersley talked about how outside groups are agitating for her to take a more populist position on the economy. Tom mentioning this movement to the center. What are we going to hear from the vice president today? What do we need to hear from the vice president? What do you want to hear from the vice president?
Well, good morning, David and Tom. Tom, maybe I'll see you up at the Greenwich Economic Forum next month. What I want to hear is flesh out continuing the opportunity economy that she alluded to during the convention and going forward. That's a big focus on new business startups, the innovation economy. Here in Connecticut, we've started more new businesses in the last few years than ever before. And frankly, a lot of them are women and minority-owned businesses. Deal with also AI and advanced manufacturing and all the other places. It's a great time to be in the startup economy. I think that'll be our focus.
I hear the former president talking an awful lot about tariffs. He was in Savannah yesterday, talked about tariffs being a beautiful word, as he put it. There's a simplicity to him saying it over and over again. People might misapprehend what it means or what the consequences might be. Our understanding is the vice president's going to talk about targeted tax incentives today. A difficult term, I think, to sell to the American public. How does she do it? How does she convince Americans that this kind of industrial policy is going to be a benefit to them?
Look, I think tariff is another word for tax. It's a middle-class consumer tax, and you're going to be paying that in terms of higher inflation and higher costs. I think, Vice President Harris has a different strategy. Obviously, with incentives, she wants to help those small companies grow and expand. More of an ownership economy, opportunity to own your own company, and also, as you know, in housing, own your own home as well. It's good to have a stake in your community.
I want to ask you about how much time there is between now and the election. You're acutely aware of it. And there's a school of thought that it's too late in the game to change minds? That voters have made up their minds. Yes, we talk about these undecided voters, few as they are in these handful of states and districts. Are you one who believes that at this point, giving a speech like this, unveiling a plan that I gather is going to be about 80 pages long, is going to do work to do that? That people can still be convinced here 40 plus days till the election?
I get the idea that out of 300 million people, maybe there's 1 million that are still persuadable in 5 or 6 states. But I think Kamala Harris, you're going to see what she has in mind when it comes to manufacturing and jobs and opportunity. I think she's very entrepreneurial in that sense.
With us now, the governor of Connecticut, Ned Lamont. We welcome all of you nationwide, Bloomberg Surveillance. David?
I've got to ask you, you mentioned taxes just a moment ago in the context of tariffs being like them in your estimation. Right. Taxation front and center in your backyard, as we had the former president traveling to Connecticut to talk about the reversal of something that he did.
Governor, we got to make this granular. Okay, we got to get granular. There's a house on North Street in Greenwich, Connecticut, that if Spielberg parachuted in, he'd say, we can use this, built in 1796, actually pretty reasonable by Connecticut standards, under $3 million. David, the property tax was rounded out to $25,207. Continue.
The former president talks about restoring the SALT deduction, which was capped when he was the president and his tax bill was pushed through. Help our listeners on Global Wall Street understand the significance of that decision that he and other Republicans made back then and the import of doing away with that cap.
Well, first of all, Tom, that house you referred to in Greenwich was probably $2 million 5 years ago. It is $3 million today. A lot of people moving into this state. But you're absolutely right, David. That SALT, reducing the deduction on that was very costly to states where we invest a lot in K through 12 education. That's reflected in property taxes. So raising that deduction level, which I think is something both Kamala Harris and former President Trump have talked about, would be very meaningful up here.
Governor, Tom often talks to me about the importance of knowing history, thinking about history. As Donald Trump makes his way through Long Island into your neck of the woods, do people remember who's responsible for putting that cap in place?
I think we'll be reminding them.
As we migrate back to the speech that we're going to get today, focusing again on this industrial policy, I wonder what the end game is here for both of these candidates. I think there is a desire to bring more manufacturing to the United States from overseas. We remember thinking again about history, about how much was made in this country before. We're not going to get back to that, are we? I mean, what's the dream? What's the vision that your candidate has, that politicians have for a sort of renaissance or resurgence of manufacturing in the United States? What does it look like?
I can tell you, in the last 6 years, we brought more manufacturing back to the state of Connecticut. We have a lower unemployment rate than the national average. That was not true for much of the generation. I think some of that is related to the fact that advanced manufacturing is very capital intensive, requires high level computer skills. If you go to some of these places, we're making jet engines and submarines. And I think that all plays to our strengths.
Ned Lamont, tell me about the fancy people. And you've had the class to stay in Connecticut. Frankly, you could do whatever you want. You've done the political game, which is fine. Those fancy people moving to Florida, what's the mistake they're making? I mean, there's a exodus from Connecticut of fancy people to Florida. Discuss that impact.
The good news, Tom, is we have more young people moving into the state of Connecticut than ever before, more young people staying in the state of Connecticut. But you're absolutely right. You know, going back even before we had an income tax, a lot of older folks and wealthy folks did go down to Florida. Hope Sound was created back in the 50s by that crowd.
Right.
Look, I think Florida is a great place to visit. Wouldn't want to live there.
I want to talk to you about a tough topic. We talked to an elite audience here at Bloomberg, but Governor Lamont, it's just simple. People in the, you look at a more challenging part of Connecticut like Bridgeport, they're not worried about Jupiter Island or Hope Sound. They're worried about drugs right now. What do you need from Washington to help this nation with our drug crisis of fentanyl?
The good news is the fentanyl crisis is receding a little bit. We're using some federal resources, a lot by the state, doing a lot more in terms of intervention early on, taking care, Narcan in the schools, doing everything we can there. But I'm a big believer in opportunity. When young people see there's opportunity there, they have a better alternative. That's why free workforce training, we guarantee you a job if you pass with those skills. I think that's a big part of the answer too, Tom.
Governor, we've been talking an awful lot about polls these last few days, and there have been plenty of them. You've seen them, I'm sure. And what seems to be bubbling up to the top is this interest in, passion for getting the economy to be in better shape. That's what voters care about. As you make your rounds through Connecticut, what are voters telling you the problems are when it comes to the economy and what needs to change? How much are they looking to Washington to affect that change?
As I go around the state of Connecticut, I think people feel like we're in a pretty good place from an economic point of view, but affordability is an enormous issue. Everything from grocery, and right now electric rates going up. Electric is a big deal for us because demand is going up through the roof. Look at data centers, and yet supply is still tough. We're at the end of the supply chain here. So that's what I hear is affordability.
Governor, I got time for one more question. It's the only one that matters. What can the governor of Connecticut do about Amtrak and the wires in the heat of August popping up from New York to Boston?
I thought you were going to ask about I-95. But
I mean, we're not going to blame this on the state of Connecticut.
Okay.
Ned Lamont, they're doing better after the tunnels in New York. They're doing better to Washington. What can we do about Amtrak in Connecticut?
I think thanks to the infrastructure bill, Tom, you're going to see a big difference there. Amtrak Joe kind of cared a lot about Amtrak. And that means everything from straightening out the rail where we can so you can get higher speeds.
Right.
One of these 100-year-old bridges, Tom, costs us about 2 minutes because you got to slow down and then speed up on the backside of it. So I think you'll see some real progress there, but it's probably going to take a decade.
I got a time, like a minute here. This is really important, Ned Lamont. President Biden speaking to the UN yesterday. We were thrilled he stopped by Bloomberg Philanthropies as well. What will be the Joe Biden legacy? You talk about Amtrak Joe. I think he's comfortable with that. But after the hellacious 6 months this president has had, what will be his Democratic Party legacy?
Builder. I think everybody, since I've been around for a while, says we're going to start rebuilding America. I think he did that. Look where we were 4 years ago with sagebrush blowing down empty streets. And now what you're going to see in terms of roads and bridges and good paying jobs and speeding up Amtrak for you, I think that'll be a big piece of his legacy.
Ned Lamont, thank you so much. The governor of Connecticut with us this morning. David Gura, thank you so much for that conversation. Just really outstanding. Joining us now for Global Wall Street, we welcome all of you around the world, across the nation. Here, Michael Mauboussin. I'm going to frame this out. David, he's got a very important Morgan Stanley piece out for Counterpoint Global Insights on stock market concentration. But I think we need to know how we got here, David Gura, with Michael Mauboussin. Somewhere in the late 90s at Credit Suisse, they put out this literature that was 7, 8, 9 pages, and you'd swear because you had to read every word. And you go, who is this I can't even pronounce his name. Who is this Mauboussin guy? And what began really culminating in the internet boom, the first boom of 2001-2, was the required theoretical read on Wall Street. He extended this from Credit Suisse to like Mason, now at Morgan Stanley. We're thrilled that Michael Mauboussin could join us for extended conversation today. Do your old essays still hold true today? Those seminal capital allocation essays that you wrote, I'm going to say it's 25 years ago. The math's still the same, right?
I think the math is the same. And, well, I guess I'll leave it to the readers to actually judge ultimately whether that's the case. But I'll say, Tom, just backing up a little bit, I was very fortunate to be able to be involved with the folks at the Santa Fe Institute, learning about a lot of these concepts like power laws and increasing returns. Right. Now those things are, network effects. These are all, it's kind of common language today.
Right.
But that was very novel, roughly 30 years ago. So I was able to be maybe a slightly bit ahead of trying to implement those ideas and thinking about it. And by the way, the internet boom was just like the classic. It was a canonical boom and bust, right? And you could see it unfold before your eyes. So you could actually write about it and say, like, we know that 90% of these companies are going to go away, but we're experimenting, right?
You nailed 8, 9, 10 essays in. I can't remember. And this is from electrical engineering folks. You don't go semi-log, you go log-log. and you end up with a hyperbola, which is that curvy thing you studied this, David, at school. You nailed that few would win. I believe Amazon was your model there. But on a log chart, a few winners would be there. You absolutely nailed that. Is that our future?
Well, the thing is, the distribution of company sizes follows a power law, and I don't know that we know exactly why that's the case. So it was true then, it was true back in the 1950s, and I suspect there's no reason to believe it's not going to be true going forward. So the answer is yes. The challenge is figuring out precisely what you said, Tom, which is which companies can lie where on that power law distribution, right? And power law, by the way, power law it ends up being a straight line when you do it on a log, but it's not intuitive when you actually run through the numbers, because obviously a log is you're doubling or you're increasing the same percentage for each tick mark.
What Mauboussin is saying is not intuitive. Is I got a C, he got an A. That's what that means. I got to get one more question here because Gura's worried about the present tense. If that's the case, and if I go to Krugman, who's been very good about monopsonistic tendencies, is there an American capitalistic tendency where the few just get bigger and bigger, the exploitation theory?
Yeah, this is another really fascinating thing. If you look at the last 20 years in particular, what our numbers show, and we do a lot of work on returns on invested capital for businesses, what our numbers show is that the larger companies have distanced themselves from the smaller companies. So people talk a lot about large cap versus small cap, but the underlying economics for these big guys is actually quite good. And I'm sure we'll talk about stock market concentration, but this ties into that argument, which is the fundamentals seem to be the case. So how does that go on forever? I have no idea. I'm more observing than I'm predicting, but the last 20 years have been quite unusual in that specific context.
Well, let's move to the present tense, but I'll stick with learning from history as well. And I wonder, as we talk about your writing on the internet in the past, how much that is an analog to what we're seeing today. How much are you thinking about what happened then as you look at what's happening now with kind of the exuberance and excitement about artificial intelligence?
Right. I think that there's a model, and you go back to the railroads and canals. I mean, everyone, radio, we see the same pattern every single time. By the way, this is well documented by an economist named Stephen Klepper, formerly at Carnegie Mellon University. And basically the pattern is this. You have a huge number of companies trying out a lot of stuff. Right. Most of those companies are going to fail, but you can think about each of them as options. Eventually, the market, in quotation marks, selects the technology that's going to win, and then everything else, they consolidate or go out of business, whatever it is. So you have this experimentation phase, and then you figure it out, and then you have this sort of waning of all the losers. Are we going every time you see a new technology come along? And by the way, it's funny. I was with a client. This is like 2001, and the guy says, "Oh, we just lived through the dot-com boom and bust. Do you think we've wisened up and that we'll never do this again?" I was like, zero probability of that. No, maybe not zero, but basically close to zero. I mean, this is how it works. And by the way, as a fascinating side note, scientists have studied, this is how our brains, actually how we develop our brains. Synaptic connections in our brains do the same thing. Right. From the time you're born to the time you're 3, you have an explosion of synaptic connections, trying all sorts. If you've ever been around a 3-year-old, we all have been. Yes. They're very inefficient little things, but they take in everything, right? But then you prune away the stuff that doesn't matter, and you keep the stuff that's good, and you go from there.
David, get stock market concentration in here.
I remember talking with Michael Hartnett of Bank of America a few years back, he who coined the term Magnificent Seven, and we talked an awful lot about the need for the market to broaden out, the concerns that we've heard about concentration. We can stay in the present tense, but pull back as much as you'd like here. How much have we seen that happen? How vital is it that we have that kind of moving back from just a handful of names and companies?
I just don't know how to answer this question. I was really reticent to wade into this topic at all. But I was like, there are a couple things that seem to be missing here. Number one is just going back further in history, right? So we went back to 1950. The concentration we see today is clearly precedented. It was the 1960s. And by the way, if you go back to the 1930s, that was basically that was the standard. But number two is he asked a basic question: is, if you had a clean sheet of paper and you knew nothing about this, how would you figure out what concentration should be? Right. The reason it's so disconcerting is because we've gone up a lot in the last decade. But what should it be? And so we said, well, one way to think about that is the underlying economic profits, right? Economic profits are return on capital times the amount of capital you have. And it turns out, for example, at the year end of 2023, top 10 companies were 27% of the market cap in the United States, and they were 69% of the economic profit. If you go back even a decade, they're typically in the high teens in terms of percentage, but they're in the mid 40s in terms of economic profit. So not to say that anything is, in quotes, justified or not justified. So widening out the market, you say like there should be an economic justification for it, not just this is how it used to be, it should go back to being what it used to be. So
I'm going to read this verbatim. I put it out on Twitter. This is Harvey D. Shapiro in Barron's with research from Arizona State's Henrik Bessembinder. Just 86 stocks accounted for half of the total stock market wealth creation over 90 years. Less than half of the stocks in the universe generated any returns. Only 42% earned more than risk-free treasuries. Less than 4% of thousands and thousands of stocks in this universe accounted for virtually all of market gains. Harvey Shapiro, tour de force in Barron's, and the guy to talk to about it, Michael Mauboussin, with us right now. Modern portfolio theory, and Peter Lynch called it diversification. Is it our evil?
I mean, this is the most challenging thing when you think about active management, because let's say, so just to play back, like you said, it's a handful of companies that generate most of the shareholder wealth over long periods of time. Let's say you're a portfolio manager and you're smart enough to have identified one of these and put it in your portfolio. Let's say you bought Apple 15 years ago. Awesome. What happens is it becomes so big in your portfolio that you blow through all of your diversification requirements.
Will Danoff's living this at Fidelity.
Will Danoff, I mean, so anybody that's big like that. So it's a funny thing that on the one hand, you see the numbers and you know that. And on the other hand, it's very difficult to actually take advantage of it. And by the way, for your own personal account, people can do this, right? Even Berkshire Hathaway, I know they sold back their Apple stake, but a couple quarters ago, it was 50% of their public equity portfolio. You can't run a fund with 50% in the largest company in the world, most liquid company in the world, right? On a viable business basis. So it's a very interesting contrast. But the point being, the fundamental point is this skewness. And by the way, it's not just the United States. You go around the world. Bessembinder did a paper around the world. Bessembinder did a world in developed and developing markets. Bessembinder did this work with some colleagues around the world. Same exact pattern. And by the way, we don't know exactly again why this pattern exists, but that skewness shows up. That extreme skewness shows up over time everywhere.
I'm curious just about the role of active management today in light of what you're saying. So for the novice or the naive, why is it still appealing today, and to whom is it an attractive option?
Right. Well, first of all, I mean, active management is never going to go away, nor can it go away, because it does two things that are vital. And by the way, these are very important positive externalities for the world. Number one is liquidity. Mm-hmm. People forget about liquidity. It rears its head when we don't want to see it. And then second is price discovery. So someone's got to make the trains run on time and deliver the mail, making price efficient. So indexers are free riders. Jack Bogle, by the way, God bless him, would completely agree with this. They are all just free riders. And not everybody can be a free rider, obviously, in some sort of a system. Right. So that's number one. Now, number two, just, David, to your point, why this has been so difficult is the average mutual fund manager who competes with the S&P 500 as his or her benchmark has an average size of their portfolio is smaller than the market cap of the S&P 500, right? So here's the logic is when large caps rip, which is what's happened in the last decade.
We've seen it, yeah.
Active really struggles, right? Because you're just not exposed. Now, by contrast, when small cap does well relative to large cap, active does really well. So that would be another thing to bear in mind. If you say, well, I think this concentration thing is going to go away, the small caps are going to do better, we're going to get more balanced market. That's actually as good a backdrop as conceivable for active management. And we have all the data in the report to sort of back up that assertion.
Michael Mauboussin on private equity. I look at the new credit and equity, the illiquidity there, the lockups. It's like VC redux once over. How's this tragedy going to end?
I like the in the question.
Not that I give my opinion, but.
No, I don't know. I mean, I think that, we wrote a huge piece called Public to Private Equity in the United States, a long-term look. We looked at took a 50-year look at public equities. Obviously the story there is there are fewer public companies around. They're all on average larger. So why do we have 60% of the companies we did in 1996? Interesting question. We looked at the rise of private equity and then the rise of venture capital and how this happened. Now, look, I think that we just came through a period of very low interest rates. And if you're running money and you have liabilities to satisfy, you needed to go out on the risk spectrum. And venture does it through speculative companies or young companies. Buyouts do it through leverage. we've come through that phase and that's done, right? So that's an interesting thing is like, what do you need to do to satisfy your liabilities? And then all these things, the problems, as you know, anytime assets flow to a certain asset class, it always becomes more challenging to deliver excess returns. And so you follow the flows to some degree. Now, look, clearly in venture, clearly in buyouts, there are niches, there are spots, there are people that will navigate effectively. So just as I don't want to say the whole thing is challenging, but by the same token, it's a story that people now understand.
Tom has done such a wonderful job of framing who you are and what you've done, and I'd love to ask you sort of what animates you or gets you thinking about one issue or another in particular. How do you approach your research? Is it what provides the flash of inspiration?
David,
that you then follow?
It builds on my wealth of ignorance. So basically, there's a puzzle out there. There's something I'm curious about. I don't understand. And even things like active to passive. We talked to public to private or stock market concentration. These are things I'm like, I don't really want to get involved with them because I know they're big controversies.
Fraud territory.
But they're fraud territory. But by the same token, I'm like, I'm not sure people are getting down to the first principles, the basics of all these kinds of things. So I think that's usually what I've done. And then I think a lot about the investment process, right? I teach at Columbia Business School. Do
you get along with Abby Joseph Cohen when she says she's darkened the door? Is it,
Yeah, I mean, she's great. I mean, she's great. We actually have a podcast up there, and we had Abby on there, and she was great. And so, although she's famous, so like it's a whole different level. But the point is that investment. So if you say like from the beginning of identifying attractive investment opportunities to building portfolios, what's the process? Every part of that piece to me is fascinating. Interesting.
Mike, here's the heart. We're going to have to cut this off pretty soon. Michael Barr's demanding more Tigers coverage. Michael Mauboussin.
We have to oblige.
I'm going to give you a nightmare. Okay, I don't care how smart you are, how smart I am. Trust me, folks. There's all sorts of company names you can whisper in my ear over money lost. How do you avoid an Intel?
Right. Well, I think this is really hard. And Intel is a case study. The framework, and we're talking about how do you think about competitive advantage of businesses? The framework is typically is if a company's making a lot of money doing something, it's very difficult for them to do other stuff.
It's Clay Christensen 101.
It's Clay Christensen 101 disruptive innovation work. And so that's the thing just to be very mindful of. And I don't know if it's apocryphal, but apparently Apple went to Intel early on and said, we've got this thing in the works called this new phone. Like, we'd love you guys to build the chips. And they're like, yeah, I don't know. Like, that market doesn't seem that big. It doesn't seem that profitable. And by the way, this x86 thing is killing it for us, right? So you get stuff like that comes along. And by the way, Andy Grove was obviously a huge Christensen fan and actually pivoted the company based on Christensen's work. So that would probably be the thing to say is to take a look and be careful about that.
I got to be 30 seconds. The new Intelligent Investor is coming out. I've promised myself I'll read it like I read it when I couldn't shave. I mean, what's the wisdom from Ben Graham and the crew from years ago that's still true today?
Gosh, and by the way, Jason Zweig's in such capable hands, such a great guy to do that. A few things. I think the two ideas I think most important from Ben Graham. By the way, Ben Graham understood behavioral finance before all this stuff was written down in a formal fashion. Number one is the Mr. Market metaphor, which is this idea that we should always understand that markets go from overheated to under enthusiastic, and so and it's often fair, but you get these extremes. And that basic framework I think is really powerful. And the other one, Tom, is margin of safety, right? Which is if you're long something, always buy something with a lot of accommodation for you to be wrong or for things to break in a way that are not optimal, but margin of safety. Those two fundamental ideas, I think, will always be around as long as we're doing this.
Michael Mauboussin, Consilient Research, Morgan Stanley. Thank you so much. Your daily look at the front page is the Lisa Mateo Hour. Lisa, what do you got?
I'm going to get you fired up because we're talking about work from home. That's right. Okay, so you remember Amazon, right? They have the new RTO policy, kicks in January, 5 days a week. They want their workers to come back. But it just so happens that they ended this popular benefit for the remote work people. Amazon gave them the option to work for up to 4 weeks fully remote from any location in the country Anywhere. They were hired. Yes, they were hired.
You're kidding.
So a lot of people took advantage because during the holidays, they did this because they were able to stay with families, still work from home. But now Amazon is saying immediately it is done. We're not having that either.
You lived this in a previous life. What do you think?
I mean, you're returned to office 6 days a week. We see you here haunting these halls.
I am. I'm here, we stop by Sunday.
It's funny. In my past job, I was working remote a lot, and there were certainly upsides to doing that. And I was able to travel a little bit. I think radio listeners can be a little bit unaware about where you are. You're able to do so much now. But I did miss and do enjoy being around folks like you, Tom, and I think that is something that's
Lisa, go to the next. I'm just
getting a little saccharine. I didn't mean to get so saccharine here.
It's just too much.
He brought a tear to his eye.
Oh my God!
My work here is done.
It's too early for Tito's, right? Continue.
Tito's and Tang. Okay, the Cybertruck, right? Everybody wanted it. $100,000 truck.
Saw Tucker's the other day.
Have you seen one in the wild?
I saw Tucker. Tucker dropped the dry cleaning off up at Milton's on Madison Avenue.
He traded
There's
in the Hummer.
Tucker's sign. No, he kept the Hummer.
Oh, he kept the
Hummer.
Hummer.
The kids have the Hummer.
Okay.
Oh my gosh.
Well, you know what it looks like, right? It looks like this futuristic stainless steel. But the problem, what the Wall Street Journal says, is the owners are complaining because they can't figure out how to clean it properly.
The one I saw
they're not painted, right? There's
No,
no paint.
no.
The one I saw looked filthy. Full disclosure. Go.
Yeah, so there's all these online forums are going crazy. One guy said he spent like $500 on cleaning products. They're using all these different things. The Tesla does say the right way to do it is to use like a soft sponge, but they don't actually recommend that you take it to a car wash. So that's the problem that these people are having. They say don't wash it in direct sunlight. Like there's all these restrictions about how you keep it clean. So now they're saying, hey, I invested all this money in this truck and now I can invest more money to keep it clean.
Can I ask a dumb question?
Please.
No. Are they like so popular they can't make them fast enough?
Well, I don't know if that's true, but they're very eye-catching. Even though I hate them, I hate the way they look, but you can't help but look, and I think that's part of the thing with them.
What do they do to other cars when they bump in the night?
They're huge. I mean, these things look huge.
They don't even dent.
Yeah, it's stainless steel. Well, it's not stainless, evidently, but it's steel.
Right.
It's not stainless.
Alloy.
Apparently it's
stainless
staining.
alloy.
Okay.
I heard someone was using like baby wipes or alcohol to clean it.
Yes, or
as
Windex.
Well. Windex.
Yes.
Next.
Okay. All right. We're going to do a 2-for-1. Okay. Twofer. We'll start with the White Sox. Okay. You know their record, right? They're on this trajectory downward, not doing so well. So there was a whole breakdown as to why this is happening. So the plan is that they were going to tank, suffer some short-term pain, but then kind of rebuild, kind of like the Cubs did, kind of like the Houston Astros did, but it just didn't work out. The reason the Wall Street Journal broke it down, they said the reason this is happening is because 8 years ago, you had then general manager Rick Hahn, Vice President Kenny Williams, they started this rebuilding project, right, with the players. But they're saying the rebuilding didn't work because those players didn't amount to a championship team. They said the problem is in the executive level. They said that when they added their legend Tony La Russa as manager, they didn't ask the others for it, and they just kind of brought him in, so they didn't have a say. So they're saying that is kind of the reason. It's that executive
level. Is she auditioning for the Fan?
There you go, right here. 37 and 120.
Is Michael K listening? She sounds awfully good.
Tom, what do you do if your record is 37 and 120?
Oh, God.
How do you rebuild
the way you rebuild is a 4 or 5 year. Mr. Rubenstein's getting the back end of this at the Baltimore Orioles. It's 4, 5, 6 years. I don't understand the pixie dust, but it's 4, 5, 6 years, and then it's supposed to click in.
I see.
Some of that's happening right now with the Detroit Tigers, and I should point out the Tigers end the season against the Chicago White Sox, and so that's actually really germane to their future. But we'll see. Okay.
I got to talk the dreaded Red Sox.
Mina Kimes just emailed in and said, Lisa, you killed that. Next.
Thank you. The dreaded Red Sox, that's where we're going. They are reportedly retiring the blue alternate jerseys.
Oh, thank God.
You didn't like them.
You didn't
okay.
like them. Do you like the yellow jersey?
No, even worse.
Oh, but they're keeping the yellow. Okay.
Well, that's a charity
thing. This is the
thing.
report. Okay, yes. Okay.
Boston's
so it's the
strong.
City Connect jerseys. Yes. Yeah. So they're keeping the yellow, but they're going to get rid of the blue, put a new one in. They don't know what the new one's going to be. So you're going to have the regular home whites, alternate home reds, road grays, yellow jerseys, and then the new City Connect jerseys as a fifth option.
Okay. No names on the back. Thank you.
Okay.
And just the whole jersey thing. What do you think?
You see it in the NBA as well.
I mean, I love the Padres have the military jersey because San Diego, it's
fair amount of
with the Navy there.
Yeah.
It's just so incredibly important. But, it's sort of like Farrow taught me in English Premier League. There's some real fails. There's some down in flames. Are you done with baseball? You got one more?
We're done with baseball. For all you soda drinkers out there, not sure if you've tried this one, but Coca-Cola is ditching the spiced flavor. I hate to break the news to you, but they're ditching it. It wasn't even on the market on store shelves for a year. Yeah. So it's gone. I guess it wasn't working out too well, but Coca-Cola did say they have a new one on the horizon. They won't say what it is. But they did have the Oreo flavor. Oreo flavor not too long ago. But the spice
Do you let that
gone.
Stuff into your house?
I do not. No
we
soda
don't either.
in the house.
I had a spiced. They were giving them away for free at the Barclays Center when you got off the subway, and I had
how
one.
was it?
It's raspberry. It tastes like raspberry.
Yes.
Yeah.
I should point out, and Mr. Bloomberg is the driver of the truck here, that
Not the Cybertruck.
he reiterated yesterday at the Earthshot Awards what sugared beverages are doing to diabetes worldwide.
Exactly.
In moderation, I think is where we would stand. Lisa Mateo, thank you for that. This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.